All right, welcome to Central San Diego. We're gonna talk about that with Sean Williams. Again, this is Chris Roth, the president of the chapter. Sean, everybody already knows you. You've been president. You're going to be president again, buddy.
Oh yeah.
But we're trying to do it. Just want to ask a question to everyone that's coming on the podcast, just so we can learn a little bit about you outside of work. So,
Sure.
don't get into too much detail, man. But just like tell us where you're from, where you live, just what you like to do outside of work.
Sure. Thanks, Chris. So originally, I'm from the Bay Area. I grew up in the heart of the Silicon Valley, a town called Mountain View, home to Google and neighboring city to Apple. Moved down to San Diego to go to San Diego State University, go Aztecs in 1999. Then got in the real estate game and haven't left. I live in Carlsbad right now with my wife Juliet and my two kids, Colton, who's 7, and Camden, who is 5. So full throttle parenting.
Yeah, buddy, I'm right there with you. All right, so let's start with the investment market, and we'll kind of go into different sections of real estate. But
Sure.
we saw on our team buyers taking a huge pause once the interest rates start popping up, and about starting middle of 2022. And it also was like, hey, pencils down, or
Yeah.
we're very selective, all these kind of terms that basically meant I'm not doing jack.
Yeah.
Are you seeing activity again, just sticking with the investment market? Are you seeing activity pick back up, or are you seeing the same as it was, call it 6 months ago?
I'd say we're starting to finally see it tick up a little bit from 6 months ago. It's not at the same levels that it was before the kind of debt market turmoil, interest rate increases, etc. There have been a couple of trades recently in central San Diego. One was a project called Kearny Mesa Landing in Kearny Mesa that was acquired by Monroe Capital. And then there's 2 other multi-tenant parks in Kearny Mesa that are on the market right now. I would say that the real limiting factor there, outside of the kind of economic uncertainty that we just mentioned, has just been lack of inventory. And in central San Diego in particular, we don't have a lot of scale. So even historically, it's been a very sought after marketplace, but the sort of deal size, both on a square footage and also the kind of price per pound, overall investment, has just been a little smaller than particularly the institutions have historically tried to play in. And then on the seller side, again, it's performed as a market extremely, extremely well. And the concern is that if somebody disposes of a well-located quality asset, it's going to be tough for them to get back in the marketplace.
So since interest rates have gone up so much at this historic rate, how far has that affected pricing? Let's just call it from a year ago. Percentage wise, just this is strictly for the investor market, not users.
Sure. So I'd say that in the investor market, you're probably 75 to 100 basis points above the historical lows. And then I would say on a price per pound basis, maybe you're 50, 60, $75. But again, Central San Diego is unique because it's got such a diverse property base that when you try and aggregate to make macro trends, you're looking at some life science developments and reconversions and R&D and multi-tenant and low finish industrial and kind of everything in between. So that's why on the onset those might sound like wide ranges. But again, San Diego is such a dynamically diverse product based kind of industrial market that I think you have to look at it that way. And for those that know that makes sense.
So you just said $50 to $75. Just so I'm clear, you're saying off of what it was a year ago. So you're saying if it was 400, now it's 350.
Yep.
Okay.
Yep. In those general ranges. Yeah.
Okay. Cool. Let's just this can be a range obviously as well, but let's just say single tenant asset. Let's call it a sale leaseback, so it's at market rate. Credit tenants, just your normal local national. We don't get specific. Just as a general number, what would you call the cap rate for like a 5-year sale leaseback?
I think on the absolute best case scenario, maybe you're 5.75. Again, going in and understanding that if a deal was maybe signed a couple years ago, that it contractual rent kind of lagged a little bit behind normal market rent growth. So I guess I'd say you're probably 5.75 to 6 or 6.25, generally speaking.
And are you seeing the next 12 months? How do you see that play out? Do you think Do you think prices are going to drop more? Do you think we're going to stay where we are? Do you think cap rates are going to flatten?
I think it's going to remain pretty steady. I say that because I think that rent growth is going to continue. I think that it maybe won't be on the same, like 20% year over year clip that we saw maybe over the past 12 months, but I still think it's going to be positive, double digit positive. I just don't know that there's going to be enough actual sale transaction data points to be able to really kind of pinpoint that. And so I think it's going to be a real case by case sort of basis there.
Okay, let's move on to the user market. We know pricing changed for investors. We just talked about that. Has it changed for the user market?
I think it's probably held a little bit flat. There's not a dramatic number of owner user sale transactions. I think that you can point to. I think that owner user pricing for call it a 40,000 foot single tenant kind of building or whatever, you're $350 to $400 a foot, and that's what we're hearing for a couple of the buildings that are out on the market. In Miramar, Scripps Ranch or Sorrento. Those are the whisper numbers that we're hearing out there.
What was it? I mean, if it's 350 to 400 right now, is that what it was 12 months ago?
It was on the higher end of that range.
Okay. How about activity levels for these buildings? So, I mean, I know for us it was wild. The 2021, early 2022. Are you seeing that market or the activity level thinning
From a leasing perspective?
Staying on the user market.
It's kind of hard to tell. We just don't have a lot of owner user inventory out there that isn't necessarily a PID or more of a one-off. And I think the other thing was for a long time, right? A long time, called the past 3 to 5 years. Investor pricing has kind of been on par with user pricing. So I think that there were certain circumstances, certain buildings that could have transacted to a user that ended up transacting to an investor.
Right.
But again, I just think it's an inventory thing. I think that now with rents being where they are, call it for generic warehouse space, maybe it was $160 a year ago, and now you're $170, $175, $180, right? Depending on your triple nets and your gross number and all the other physical natures of a building. I think that there's some well capitalized tenants that are saying, look, if I'm gonna be in a business and in this particular building, and I can look 15, 20 years down the road. If I'm going to go get traditional financing, that may not make sense. But if I can qualify for SBA, and you kind of run an analysis or a point of indifferent analysis between what your rent's going to look like and the uncertainty of future rent growth and all these other sorts of things, I think there's a certain profile of tenant that would find acquiring and owning right now as an owner user attractive.
So staying on the user market, 12 months out, are we thinking we're going to get a slew of space hitting the market because of recession? Do you think pricing is going to come down because of that? Do you think things are going to remain the same? What's your prediction?
I think it's gonna remain, I don't know, kind of the same. Again, it just goes back to I don't know that there's going to be a dramatic amount of data points. And the thing is, not only can you quantify upside if there's not a lot of data points, but it also doesn't motivate people to say, "Hey, I'm overpriced. Let me go down." Right? I mean, it's just kind of unproven. And I do think that there'll be some trades here over the call it the next balance of the year, maybe trickling into early next year that will be good solid data points. But if you're trying to say, hey, look, I need to justify buying a 40,000 foot building, you're not going to get 10 comps, right? So and that's where I think it comes down to just a one-off person saying, I love this building, it works perfect for me, and I'm going to pay whatever I can to get it. Versus more of a traditional marketplace where there's more inventory and there's just more activity going on that you can actually track.
How about, and this is kind of a question for the user and leasing market, but how is the conversion of some of your assets changed, or how do you think that's going to affect things moving forward?
So that's had a big effect on central San Diego, and I mean it's to the tune of over 2 million square feet, right? That's been taken out of the general industrial stock and is either planned or under construction to be redeveloped into life science, and so some of the demand, the displacement demand of tenants in those buildings, needing to come out and find a home, we have seen. But I think that's a sort of third leg of demand, if you will, in central San Diego that's going to continue to play out over the next 3, 4, 5 years. And I say the third leg of demand because you're still going to have just normal organic growth from existing tenants that grow, consolidate, move, etc. I still think you're going to have continued attractiveness just to come to, central San Diego or San Diego in general from, other companies that either make acquisitions of businesses or, want to service the San Diego area, et cetera. So I think that, again, that displacement demand to the tune of, call it, 200-300 tenants, depending on size and exactly how you're tracking it. I think that's going to be a continued significant contributor to absorption, demand, and fundamentals for Central San Diego moving forward.
So that kind of leads me into my next question, which goes into the leasing market.
Yeah.
Has that led to leasing activity being continued to be healthy? I mean, like going back to what I said.
Yeah.
It was like we'd list a building in 2021 and get 4 tours and 4 offers. It was crazy. That was unusual. I mean, what's it look like for you right now?
So it slowed down a little bit from that respect, but it's still healthy. I think that there's a couple things at play, right, that impact that in Central San Diego, and I'm going to focus these comments more on like the low finish, call it 40 plus
functional space.
Functional stuff. So there's a couple things at play. One is Central San Diego is going to sit, depending on whose numbers you look at it, 30 to 40 cents per square foot per month higher on a base rent than you're going to find in North County or in South County, right? And in Central San Diego, a lot of the average vintage, I would say, industrial buildings, call it late 70s to mid 80s, right? So they're not functionally obsolete, but they're just not built to the same physical standards with clear height, circulation, dock count, et cetera, that you'll find in some of those other markets. So what we're seeing now, particularly in that larger size range, is companies saying, man, I love Central San Diego. It's great logistically. It's close to whoever, but
I can't find what I want.
I can't find what I want. Or, well, there's such a potential lower rent if I look in these other markets that I at least got to go dip the toe in and see what that looks like. And so how that's translated is there's been a couple circumstances of tenants leaving Central to go down there. But really what it does is it just draws out the lease process because, everybody is a little more cautious. They want to, make sure that they're checking every box in terms of the ifs and the whats and the hows.
The pressure isn't there anymore.
Right.
Man.
Right.
We're seeing that for sure.
Right. And I don't see that changing either.
Right.
But the other thing I think is right now, just based on whatever economic news, negative kind of perception we're in, we're not seeing a tremendous amount of growth requirements. And that's not a bad thing. But it's like you're not seeing a tenant that's maybe in 40 that needs 60 or somebody that's in 60 that needs 80. Now, conversely, we're not seeing a ton of people that are in 60 that need 40. So it's kind of
that sounds like a renewal to me, Sean.
And that's exactly where I'm getting. Again, when you get to that, call it 40,000 square feet or higher, particularly in the low finish segment, renewals are outpacing new deals.
Right.
Almost 9 to 1.
Right.
If you will, depending on how you look at it. And
so you get a lot of looky-loos that end up staying where they are.
Yeah, and you kind of got to filter through that. So again, I think demand's good, but we haven't seen like prices be decreased to a point on vacant spaces that it's attractive enough with move cost, disruption, et cetera, for a tenant to leave 40,000 feet to go lease 40,000 square feet.
Right. Okay. Are you seeing more competition with your listings? Are you seeing more properties coming to the market, vacancy increasing?
Vacancy, yes, but not as much as availability. And so some people could argue that today's availability is tomorrow's vacancy. But again, in Central, I don't see that as dramatically as maybe other markets. And so there's some stuff that's coming back, but it's sort of the lower clear, inferior locations, not as efficient loading. I mean, it's the more functionally challenged spaces that were absorbed when the market 2-3 years ago post pandemic was just absolutely on a fire from a historic level. So you're starting to see some of that stuff that was vacant for a long time and then was leased kind of come back. But I was also told getting into this business that the barometer from a vacancy perspective of a healthy market versus a challenged market is 10%. Central San Diego, all industrial, you're call it 2.5-3%. So again, depending on whose numbers you're using and how you slice and dice it, we're building some new stuff, but it's not like we're going to be adding massive percentage points of new construction to the overall product base. So again, I think that San Diego is well positioned. I don't think that we're going to be oversaturated with space. I don't think there's going to be a mass exodus. And I see things kind of hanging tight for the next, call it 8, 9, 10, 12 months. Maybe downtime's a month or two longer. Maybe, renewal concessions get another month or two of free rent. But I just don't see there being a dramatic downturn. And I believe very strongly in the overall health of Central San Diego.
Do you see, I mean, you kind of answered it, but you don't see a lot of things changing. So my question was going to be, do you see anyone dropping lease rates? But it sounds like you kind of said you think more concessions are coming, and there's not going to be enough vacancy to push that.
Correct. And again, it's while the vacancy is kind of ticking up a little bit, it isn't again to a point where I think people are severely scared about it or intimidated by it. I mean, I still think that the general perception is if you have a deal, like make the deal. But that's both on new and renewal. And going back to the point I made, if somebody's in 40,000 square feet looking at 40,000 square feet, it's a lot easier if they're in your building currently to figure out a way to keep them than it is to incentivize somebody to relocate in kind of a musical chairs lateral move to come take your new building.
What are you saying? Let's just from market to market. I'm trying to understand pricing.
Yep.
What would you say a standard 40,000 square foot dock and grade industrial building goes for?
I think that on a base rent basis, you're call it 175 to 185 net. That's the easiest way to look at it. I mean, obviously, it's a little easier if you've got lower operating expenses to hit that
makes sense.
Gross number. But generally speaking, that's where it's at. I think that's going to trend upward, and I think that you'll see maybe end of 24, second half of 24. I think you'll see $1.95, $2 net warehouse rents in Central San Diego.
What are we thinking? Let's move to development. There isn't much land to develop, but let's assume a piece of dirt comes available. There's a lot of variables in here, but just give me a range. What do you think a piece of dirt's worth?
I think that you're 85 to low hundreds a foot. I know that's kind of a wide range, but it varies on is it a covered land play, and so you got to kind of take maybe a little discount on the land because you're going to have to spend money to get to the land. But that's consistent with what we're seeing in underwriting for people that are buying assets either to reposition or just to have that land number baked into their numbers.
Is there anything slated for construction, under construction in Central?
The two most exciting pieces of development in Central San Diego. Rexford bought 88 Balboa in the heart of Kearny Mesa as a covered land play a couple years ago. They're in the process of getting the building out of the ground, and I think it's going to be really nice and really well sought after in the marketplace. And then LBA.
How big is that? Did you say
120?
Okay.
And then LBA is also in Kearny Mesa repositioning a Class B office building into 95,000 square feet of warehouse space. All those buildings are going to be built to the great standards, like the right clear height, 30 plus, the right kind of docks, the right kind of truck court, optimal kind of circulation, et cetera. I mean, I think both those buildings are going to be great, and I think the market's going to welcome them.
All right, all good things, bud. Well, one more thing. Give us a prediction 12 months from now we haven't talked about.
There'll be a parade in Santa Clara where the San Francisco 49ers are hoisting the Lombardi Trophy.
Ooh. No, that's
Brock Purdy, baby.
Is he coming back?
Oh, yeah. He's all healthy, man.
Trey Lance. Everyone gets hurt in that city, man. Trey Lance coming back. All right, bud. Well, thanks for coming in. Appreciate it. All good info. And on to the next market.
Awesome.